The great wealth transfer has already started. We are living through one of the largest financial transitions in human history, but it is not happening through headlines, political speeches, or sudden economic collapse. Instead, it is unfolding quietly, generation by generation, inside families, bank accounts, and property records around the world. Trillions of dollars in wealth are beginning to move from one generation to another, reshaping ownership of assets, power, and financial opportunity on a scale never seen before. This shift is not just about money changing hands. It is about a complete restructuring of who owns assets like real estate, stocks, businesses, and investment portfolios. For decades, wealth has been concentrated in the hands of older generations who benefited from lower asset prices, our easier home ownership conditions, and decades of economic expansion. Now, that accumulated wealth is beginning to transfer to younger generations, but not evenly, and not without major consequences for society. What makes this moment unique is the combination of aging populations, rising asset prices, and long-term economic growth that has built enormous wealth pools in certain generations. As these holders of wealth age, their assets do not disappear. They are passed down, inherited, or redistributed. This creates a financial transition that will influence housing markets, investment behavior, inequality, and economic opportunity for decades to come. But this transfer is not simply a smooth passing of financial security from parents to children. It is uneven, complex, and deeply shaped by economic systems, tax structures, and asset concentration. Some individuals will inherit life-changing wealth, while others will inherit very little or nothing at all. And this imbalance is what makes the great wealth transfer one of the most important economic stories of our time. To understand what is coming, we first need to break down what this transfer actually means, who it affects, and why it is happening now. What the great wealth transfer actually means. The great wealth transfer refers to the massive movement of assets from older generations to younger generations as part of inheritance, estate planning, and intergenerational wealth transition. It is not a one-time event, but a long process that unfolds over decades as populations age and accumulated wealth changes hands. At its core, this transfer is driven by demographics. Our older generations have spent decades building wealth through property ownership, retirement savings, business growth, and long-term investment in financial markets. As these individuals reach later stages of life, their wealth does not vanish. It is systematically passed down through inheritance systems, legal structures, and family planning mechanisms. This means that trillions of dollars in assets are gradually shifting ownership. These assets include not only cash, but also real estate, stocks, pension funds, businesses, and investment portfolios. The scale of this transfer is unprecedented because previous generations have accumulated more wealth than any generation before them, largely due to decades of economic expansion and rising asset values. However, this transfer does not automatically create equality or financial stability. The impact depends heavily on how wealth is distributed, taxed, and managed after it is passed down. In some cases, it leads to financial security and upward mobility. In others, it simply reinforces existing inequality, concentrating wealth within already wealthy families. In simple terms, the great wealth transfer is not just about inheritance. It is about the reshaping of financial power across generations. It determines who owns the future economy and who must continue relying on income rather than assets. The generational shift of money and assets. The generational shift of money and assets is one of the key forces driving long-term economic change. Wealth is not static. It moves through time as different generations enter and exit the financial system. Each generation experiences different economic conditions, asset prices, and opportunities for wealth accumulation, which creates very different financial starting points. Older generations, particularly those who bought assets decades ago, benefited from significantly lower real estate prices, lower education costs, and higher relative returns on traditional investments. Over time, these advantages compounded, allowing them to accumulate substantial net worth, often heavily tied to property and long-term investments. Now, as this generation ages, those assets begin to shift ownership. Younger generations inherit not only wealth, but also the economic conditions attached to it. This includes rising housing costs, higher debt burdens, and more competitive financial environments. The transfer of wealth does not erase these challenges. It simply redistributes existing assets into a new context. At the same time, younger generations are often more financially diversified but less asset-heavy. Many rely on income, digital investments, or smaller-scale savings rather than large property holdings. This creates a mismatch between inherited wealth and lived economic reality, especially when large asset transfers occur unevenly. This generational shift also changes behavior. As inheritance becomes more common, financial planning, investment strategies, and even consumption patterns begin to adjust. Wealth is no longer only built from income. It is increasingly influenced by what is inherited, not just what is earned. Baby boomers passing down trillions in wealth. One of the most significant drivers of the great wealth transfer is the aging baby boomer generation, which holds a disproportionately large share of global wealth. Saw over decades of economic expansion, rising property values, and long-term investing, this generation accumulated vast financial assets that now represent a major portion of total household wealth in many countries. As baby boomers age, they begin to transfer this wealth through inheritance, gifting, and estate planning. This includes homes, retirement accounts, stock portfolios, businesses, and other long-term investments. In many cases, these assets have appreciated significantly over time, meaning the value being transferred is far greater than the original purchase price. This creates a situation where trillions of dollars are expected to move between generations over the coming decades. However, this transfer is not uniform. Some families will pass down substantial wealth, while others will have little or no financial assets to transfer. This creates a widening gap within the same generation of heirs, depending entirely on family background. The scale of this transfer also has macroeconomic effects. As large amounts of wealth change hands, it influences housing demand, investment flows, and consumer behavior. Inherited wealth often enters markets differently than earned income, frequently being invested rather than spent, which can further increase asset prices. This process ensures that the financial legacy of one generation continues to shape the opportunities and constraints of the next, long after the original wealth was created. Inheritance boom. Who is receiving the money? The inheritance boom refers to the rising flow of inherited wealth being passed down to younger generations. But the distribution of this wealth is far from equal. While large sums are being transferred overall, the majority of inheritances tend to concentrate among a smaller portion of the population that comes from wealthier families. Those receiving the largest inheritances are typically individuals whose parents or grandparents owned significant assets, such as property portfolios, businesses, or long-term investment holdings. These transfers can instantly change financial status, providing access to housing, investment opportunities, and financial security that may otherwise take decades to build. However, a large portion of the population receives little to no inheritance at all. This creates a growing divide between those who experience a wealth-based financial boost and those who must rely entirely on earned income. Over time, this difference significantly impacts life opportunities, especially in housing markets and long-term financial planning. In many cases, inheritance is becoming one of the most important determinants of financial stability. It can influence whether individuals are able to purchase homes, start businesses, or invest in assets early in life. Without inheritance, many are forced to enter markets at significantly higher prices than previous generations. This uneven distribution reinforces existing economic inequality, as wealth continues to circulate within families rather than spreading evenly across society. As a result, inheritance is no longer just a personal family matter. It has become a major economic force shaping entire populations. Real estate as the core of the transfer. Real estate plays the central role in the great wealth transfer because it represents the largest and most widely held form of wealth among older generations. For many households, property is not just an asset. It is the primary store of value accumulated over decades of economic growth. As property owners age, these assets are typically passed down to heirs, either directly through inheritance or indirectly through estate planning. This makes real estate the backbone of intergenerational wealth transfer. In many cases, a single property can represent a life-changing financial inheritance, especially in high-value housing markets. The importance of real estate is amplified by long-term price appreciation. Over decades, property values in many regions have increased significantly due to urbanization, population growth, and monetary expansion. This means that inherited properties often carry far greater value than their original purchase price, further increasing the scale of the transfer. However, real estate inheritance also contributes to market dynamics. As properties are transferred, sold, or retained within families, it affects housing supply, affordability, and demand. In some cases, inherited properties are kept as rental assets, further reducing availability for new buyers and increasing competition in housing markets. This makes real estate not just a passive asset in the transfer of wealth, but an active force shaping economic inequality, housing accessibility, and generational financial outcomes. Stock market ownership shifting hands. One of the most important but less visible parts of the great wealth transfer is the gradual shift of stock market ownership from older generations to younger ones. For decades, equities have been one of the primary vehicles for building long-term wealth, especially for those who had early access to retirement accounts, pension plans, and decades of compounding growth in global markets. Older generations accumulated large portions of their wealth through long-term exposure to stock markets during periods of expansion, low entry valuations, and sustained economic growth. Over time, these holdings became a major source of retirement security and intergenerational wealth. Now, as these portfolios are passed down through inheritance or estate structures, ownership of major corporate assets is slowly transitioning into the hands of younger generations. However, this transfer is not immediate or uniform. It happens gradually through inheritance events, estate settlements, and financial restructuring. As a result, ownership of global companies is slowly changing hands, even though the structure of markets remains the same. Index funds, retirement accounts, and brokerage portfolios are increasingly becoming the vehicles through which wealth is redistributed across generations. At the same time, younger investors are entering the market earlier than previous generations, often through digital platforms and passive investing tools. This means that while inheritance is transferring existing wealth, new participation is also reshaping ownership patterns, creating a more diverse but still uneven distribution of equity ownership. Over time, this dual process, inheritance-based transfer and early market participation, is reshaping who owns corporate wealth globally. But despite broader access, the largest share of stock market value still remains concentrated among those who benefited from decades of accumulation, making this transition slow and structurally unequal. Why millennials are positioned differently. Millennials occupy a unique and complex position in the great wealth transfer because they are both late entrants into traditional wealth-building systems and early participants in modern financial ecosystems. Unlike previous generations, many millennials came of age during or after major financial disruptions, including global recessions, rising housing costs, and rapid technological change. One of the defining characteristics of this generation is timing. Millennials entered adulthood during periods when asset prices, especially housing, had already begun to rise significantly. This meant that many faced higher barriers to entry for property ownership compared to older generations who acquired assets at much lower valuations. At the same time, millennials were among the first generations to widely adopt digital financial tools, online investing platforms, and globalized income opportunities. This has allowed for more flexible wealth-building strategies, but also introduced greater volatility and competition in financial decision-making. Unlike older generations, millennials are also more likely to carry student debt, delayed home ownership, and fragmented career paths, and which affects long-term wealth accumulation. However, they are also increasingly positioned to benefit from inherited wealth transfers as baby boomers and older generations pass down assets. This creates a dual reality. Millennials are simultaneously behind in traditional asset ownership, but positioned to receive one of the largest wealth transfers in history. Their financial future is therefore shaped not only by income, but by how much inherited wealth flows into their generation over time. Why Gen Z will inherit more than any previous generation. Generation Z is expected to inherit more wealth than any previous generation in history, not necessarily because they earn more, but because they are positioned at the end of a long accumulation cycle. As global wealth has grown over decades, and as older generations reach advanced age, the concentration of assets is reaching a point where large-scale transfers become unavoidable. This means that Gen Z will be the primary recipient of the ongoing great wealth transfer. They will inherit assets accumulated not only by baby boomers, but also partially from older segments of Gen X, depending on family structure and regional demographics. In many cases, these inheritances will include real estate, investment portfolios, retirement accounts, and business ownership. However, this does not mean that all members of Gen Z will experience equal financial uplift. Wealth transfer is highly dependent on family background, meaning that inheritance will remain unevenly distributed. Some individuals will receive substantial financial support, while others may receive little or none, reinforcing existing inequality within the same generation. At the same time, Gen Z is entering adulthood in a financial environment shaped by high asset prices, digital economies, and globalized labor markets. This means that inherited wealth will play an even more important role in determining access to housing, investment opportunities, and financial security. In many ways, Gen Z is positioned at the intersection of two forces: historic wealth accumulation from previous generations and modern economic pressure from high costs of living. This combination makes inheritance not just beneficial, but in many cases, structurally significant for long-term financial stability. The role of technology in accelerating wealth movement. Technology is accelerating the great wealth transfer in ways that were not possible in previous generations. Say, digital financial systems, online banking, automated investment platforms, and global communication tools have made it easier than ever to manage, transfer, and distribute wealth across generations. Estate planning and inheritance processes, which once took significant time and legal complexity, are now increasingly digitized. Financial assets such as stocks, bonds, and even real estate ownership records can be transferred more efficiently through integrated financial systems. This reduces friction in the movement of wealth, allowing transfers to happen faster and at larger scale. At the same time, technology has democratized access to financial markets. Younger generations can now invest, trade, and build portfolios from mobile devices, often without traditional intermediaries. This increases participation in asset markets, which are central to wealth growth and preservation. However, technology also amplifies inequality in subtle ways. Those with access to financial education, digital tools, and capital can scale wealth faster, while those without access may remain excluded from these systems. This creates a widening gap between participants in modern financial ecosystems and those outside them. In essence, technology is not just facilitating the transfer of wealth, it is accelerating the speed, scale, and efficiency of how wealth moves, while simultaneously reshaping who is able to participate in that movement. Rising inequality and wealth concentration. As the great wealth transfer unfolds, one of its most important consequences is the increasing concentration of wealth within certain families and groups. While total global wealth is rising, its distribution is becoming more uneven, with a larger share controlled by those who already hold significant assets or are positioned to inherit them. This concentration is driven by compounding effects. Wealth generates more wealth when invested in appreciating assets such as real estate and equities. Over time, this leads to a feedback loop where asset owners benefit from rising prices, while non-owners struggle to enter the system at the same level. Inheritance plays a major role in this dynamic. Families that already hold significant wealth are able to pass down financial advantages, including property, investment portfolios, and business ownership. This creates a cycle where wealth is preserved and expanded within certain lineages, rather than distributed broadly across society. Meanwhile, those without access to inheritance must rely primarily on wages, which often grow more slowly than asset prices. This structural imbalance contributes to widening inequality between asset holders and non-asset holders, regardless of education, effort, or employment status. Over time, this leads to a financial landscape where wealth is increasingly concentrated and economic mobility becomes more dependent on existing family assets rather than purely individual income. The Great Wealth Transfer, therefore, is not just redistributing wealth. It is reshaping the entire structure of economic inequality itself. Tax systems and their impact on wealth transfer. Tax systems play a critical but often overlooked role in shaping how the Great Wealth Transfer unfolds. Now, while inheritance is the natural mechanism through which wealth moves between generations, taxation determines how much of that wealth is preserved, redistributed, or reduced during the transfer process. Different countries apply different rules, but the underlying principle remains the same. Governments take a portion of wealth as it changes hands. In some cases, inheritance taxes and estate duties significantly reduce the total value passed down. This can limit the concentration of wealth within families and create more redistribution toward public revenue. In other systems, lower inheritance taxes or strategic exemptions allow large portions of wealth to pass through generations relatively intact, reinforcing long-term family wealth accumulation. Beyond inheritance tax itself, other forms of taxation also influence wealth transfer. Capital gains taxes, property taxes, and wealth-related levies can all affect how assets are managed before and after transfer. Families often engage in long-term financial planning to minimize tax exposure, using trusts, holding structures, and legal frameworks to preserve wealth across generations. This creates an important divide between those who have access to advanced financial planning and those who do not. Wealthier families are often able to structure their assets in ways that reduce tax impact, while middle and lower income households may transfer fewer assets and lose a larger proportion of value relative to their total wealth. As a result, tax systems do not just collect revenue. They actively shape the speed, scale, and distribution of the Great Wealth Transfer. They influence whether wealth becomes more evenly distributed across society or remains concentrated within specific families over time. Risks that could disrupt the transfer. Although the Great Wealth Transfer is expected to be one of the largest financial movements in history, it is not guaranteed to proceed smoothly or without disruption. Several systemic risks have the potential to alter its scale, timing, or impact on global wealth distribution. One major risk is economic instability. Severe recessions, financial crises, or prolonged market downturns could reduce the value of assets before or during the transfer process. Since much of inherited wealth is tied to real estate and financial markets, declines in asset prices could significantly shrink the total value being passed down. Another risk comes from policy and regulatory changes. Governments may adjust tax laws, inheritance rules, or financial regulations in response to rising inequality or fiscal pressures. Such changes could reduce the amount of wealth transferred or alter how it is distributed across generations. Demographic uncertainty is also a factor. While aging populations are driving the transfer, unexpected shifts in population growth, migration, or longevity could affect the timing and scale of inheritance flows. Longer lifespans, for example, may delay the transfer of wealth further into the future. Technological disruption and financial system changes also present risks. Rapid shifts in markets, new asset classes, or changes in how wealth is stored and transferred could reshape the structure of inheritance itself. In extreme cases, new financial systems could redefine what counts as wealth or how it is measured. Despite these risks, the underlying trend remains powerful. A large stock of accumulated wealth is set to move between generations. However, the final impact of this transfer will depend not only on how much wealth exists, but on how stable the economic, political, and financial systems remain during the transition. In the end, this transfer is not just about money changing hands. It is about the structure of economic life itself being rewritten. It will influence who can afford homes, who controls corporate ownership, and who has the ability to build long-term financial security. Some will step into inherited stability, while others will continue navigating rising costs and competitive markets. And as this process continues, It will quietly define the next era of global inequality, opportunity, and wealth distribution.